Welcome to The Explainer. We're about to tackle a question that really could make or break your financial future. Should you be a stock picker, always hunting for that next big thing? Or should you be a passive investor, just buying the whole market? Let's find out. This is it, right? The classic investor's dilemma. Are you going to swing for the fences, hoping to hit that one home run that changes your life forever? Or are you playing the long game, looking for that consistent, reliable growth? Look, there's no single right answer, but by the end of this, you're going to know the right answer for you. Okay, so let's start with the basics. When you buy a stock, you are literally buying a tiny piece of an actual company. You become a part owner. You're placing a bet on the future success of that one specific business, whether it's Apple or Microsoft or Nvidia. But what if you don't want to bet on just one horse? Well, that's where ETFs come in. Don't think of them as a single company. Think of them like a giant basket holding hundreds, sometimes thousands, of different stocks all wrapped up in one single, easy-to-trade package. This visual really nails the core difference. With stocks, you're the shopper. You're carefully inspecting each apple, each orange. But with an ETF, you're just buying the whole fruit basket. You get a little bit of everything, all ready to go. So why would anyone choose to pick their own fruit when that big basket is sitting right there? Well, the potential rewards, they can be absolutely enormous. Let's take a look at the upside. The biggest draw, of course, is that dream of finding the next Amazon or Tesla and just watching your investment go to the moon. But beyond that, you're in the driver's seat. You decide what to buy, when to sell, and you're not paying anyone a fee to manage your money. You can even build a portfolio that reflects your personal values, investing only in companies you truly believe in. But, with great control comes great responsibility. A single bad earnings report, one negative news story, and your investment can just plummet. To do this well, you have to be ready to spend hours, I mean hours, poring over financial statements and market trends. And let's be honest, watching your money jump up and down every single day can be a serious emotional roller coaster. So, if picking stocks is like a high wire act, then ETFs are the safety net below. Let's explore the much calmer, more diversified world of funds. This is where you see the incredible power of instant diversification. With a single click, you can own a piece of the entire tech sector or the whole S&P 500. This spreads your risk so widely that the failure of any one company isn't going to sink your portfolio. It's the ultimate set-it-and-forget-it approach, letting you ride the wave of broad market growth without needing a PhD in finance. But hey, there's no free lunch in investing. You're going to pay small annual management fees for all that convenience. And by owning everything, you're pretty much guaranteed to get, well, average market returns. Your big winners are always going to be weighed down by the laggards in the fund. Plus, you have no say in what you own. If you don't like a company, too bad. You're stuck with it as long as it's in the index. All right, we've seen the pros and cons on paper, but now it is time for a serious reality check. Decades of market data tell a very different and, frankly, a very sobering story about trying to pick individual stocks. This number, 4%. It might not look like much, but according to some groundbreaking research from Arizona State University, it is the absolute key to understanding where pretty much all of the stock market's wealth has actually been generated. Just let that sink in for a minute. For almost a century, all of the net wealth created by the U.S. stock market came from just 4% of companies. It just powerfully shows you how incredibly rare these superstar companies are and how hard it is to find that needle in a haystack of thousands. So the odds of picking a huge winner are slim. But what about the odds of picking a catastrophic loser? Well, research from JP Morgan reveals an even more startling statistic. Wow. Nearly half of all individual stocks suffer a catastrophic collapse and never recover. What that means is your chances of picking a major loser are about 10 times higher than your chances of picking one of those 4% superstar companies. The odds are just not in your favor. Okay, so ETFs seem a whole lot safer. But here's the catch. Not all ETFs are created equal. Fees matter a lot. Let's imagine two investors over 30 years. Investor A picks a low-cost ETF that just matches the market's 10% average return. Investor B is in a slightly more expensive fund that underperforms by just a little bit. The difference seems tiny, right? Well, think again. After 30 years, our low-cost champion, Investor A, has a staggering $5.5 million. That is the raw power of compounding when you don't have the drag of high fees. But what about Investor B? After paying those seemingly small extra fees, they end up with only $3.8 million. That is a $1.7 million difference. That's not just a number on a screen. That is a completely different retirement, all because of some small hidden fees. So what do? We're faced with this tough choice: the high-risk, high-reward world of stocks, or the safer but kind of average returns of ETFs. But what if there's a way to get the best of both worlds? Well, many pros think so, and they use what's called a hybrid approach. It's called the core satellite strategy, and the idea is really simple. The large core of your portfolio, say 70% of it, is invested in safe, low-cost, diversified ETFs. Then, that smaller satellite portion is where you can take your shots on a few individual stocks you really, truly believe in. So, what's the right mix for you? Is it 70-30, 90-10? There's no one-size-fits-all answer here. It all comes down to your personality, your goals, and frankly, where you are in your life. This table here gives you a simple framework to help you find your mix, but you have to be honest with yourself. How much time are you really willing to spend researching stocks each month? How would you actually feel if your portfolio dropped 20% tomorrow? And how long do you have until you need this money? Your answers to these questions will guide you to the right balance. At the end of the day, the debate between stocks and ETFs isn't really about which one is better. It's about finding the strategy that's right for you. The data is crystal clear. Picking winners is incredibly hard, and fees can be a silent killer of your returns. But with a smart strategy, you can build a portfolio that lets you sleep at night while still reaching for your goals. So the question is no longer, what should I buy, but what kind of investor do I want to be?